I am Jeremiah Ajuda Dusu, the author of Jad's Business and Financial Accounting.
Man is man and can't nobody take it. I put my pit in jar and can't nobody shake it. Now
welcome to class. Okay, we're still on it there. All right, let's not waste time today. Of course, it's still group balance sheet. Okay, excuse me. So we are moving forward, definitely. So let's go. Okay, what we are looking at here, it's still group or consolidated balance sheet, of course. Then we are looking at bill of exchange involving a subsidiary. Okay, so at this level, I do believe that you have or you're familiar with bill of exchange and accounting of bill of exchange. Okay, but if you're not familiar with that, maybe we should just have a brief background about, or let's have a brief understanding or a brief on bill of exchange. Okay, so basically when we say bill of exchange, we're talking about three parties minimum, definitely. Okay, where one party is writing, of course signed, is writing an order, okay, order on a particular person to pay a certain amount of money to the third person, either on demand or at a fixed period of time. This is what I'm saying. Let's say we have Mr. X, Mr. Y, and Mr. what? Z. Okay? Now, Mr. X raises or draws a bill of exchange on Mr. Y. Okay? To pay Mr. what? Z a stated amount of money when Mr. Z demands for it, or on a particular date as stated on the document raised by Mr. what? X. So you can take a clue from a check. When you issue a check, okay, you issue a check, let's say you issued a check in favor of Mr. Obedient, okay, in favor of Mr. what? Obedient. Okay, now Mr. Obedient takes the check to the bank, of course your bank, on which the check is drawn, on which the order is given. So basically, if you are giving Mr. Obedient a check, Mr. Obedient will take the check to your what? Bank, or to your bank to cash the check. So a check is also a form of what? Bill of what? Exchange. Okay? But a very similar one is your bank draft. Of course, you know what your bank draft is. Your bank draft is very similar to bill of exchange because it's as good as cash anyway. You know your bank draft, or manager's check. Bank manager's check can never bounce anyway. So the bank draft is very similar to bill of what? Exchange. So all we're saying is that one person is giving a written order to a second person, okay, to pay a third person an amount of money. when the third person demands for it, or on the day stated on the what? Document. That's bill of what? Exchange. Okay? Now, remember that the way bill of exchange works is that, of course, you're going to have someone which owing you as a business person. Let's say A Limited. A Limited sells or sold goods. Let me say A Limited sold goods on credit. I'm trying to run us through the accounting for bill of exchange now. A Limited sold goods on credit to, let's say, B Limited. Okay? That's let's say 300 naira. So for this transaction, of course, this is A Limited's books. In this A Limited book now, we're going to have sales, right? We're going to have sales, and then we're going to have what? Debtor. Who's the debtor here? In A Limited's book, the debtor is what? B Limited. So you're crediting sales and debiting this guy. Let's bring this guy here. The debtor is B Limited, right? So this is the book of A Limited. This is the book of A Limited. So what do? You credit what? Sales. Let's say this happened on the 1st of June 2002. So here you have 1st June 2002. How much? 300. Credit sales. You debit who? B Limited. Okay? So this is the what? The entries for these credit sales from the perspective of what? A Limited, or in the books of A Limited. Now, this debtor, which is B Limited, from his perspective, purchased, right? Let's finish A Limited's perspective first. So this guy here can issue a bill of what? Exchange. Okay? As a result of this transaction. That simply means that there's going to be a documentary order to pay this money on demand by what? A Limited, or on a date stated on the what? On the document. Okay? So this guy here can issue a bill of exchange with respect to this transaction. So where A Limited accepts it, then it means it can fly. So that means you're going to have this debt off. Okay? Let's say this. Okay? So we'll say B receivable, because from the perspective of what A Limited, he has accepted the bill, become bill receivable 300. So the debt or debtor account, okay, or the debtor balance is now transferred to where? To bills receivable what? Account. Debit credit. So it will come here. Let's say 1st of June, with the debtor, B Limited. How much? 300. So it means that what? There is a bill receivable from B Limited to the tune of 300. So if the bill, okay, that has been received or accepted by A Limited says the payment should be made on the 31st of, or let's say 30th of June 2002. So that means we expect this money to mature, we expect this bill to mature on 30th 2002, right? So on 30th 2002, what happens? We expect that this money will clear. It will clear to where? To the bank. So the money comes to the bank here, 30th June 2002. We have what? So that settles this transaction with the use of what? A documentary order, okay, to pay on the 30th of June 2002. Now this is from the perspective of A Limited. So from the perspective of B Limited, instead of it to be bills receivable, it will be what? Bills payable. Of course, remember, this is A Limited's book. So that means that in B Limited's book, you know, it is sales in A Limited. It will be what? Purchases in B Limited. So we have purchases. That will be what? 1st of July, or June rather, 02. We purchased from A Limited, right? 300, just like we have B Limited here. So that means you now have here, it's going to be creditor. Who is the creditor now? A Limited. This is the book of B Limited. Right? So here you have 1st June 02, right? Purchases. How much? 300. Now that you have issued the bill of exchange to what? A Limited, of course. B Limited issued the bill to what? A Limited. From A Limited, it is bill receivable now. From B Limited to what? Bills payable. So we have what? Bills what? Payable. So take it out of this place. 300, it comes here. Right? A Limited. So of course the bill will mature when? On the 31st or 30th of June 02, right? So when it matures, it will leave this place. Right? 30th June 02. Of course, money will come out of the bank. 300. So we have your bank here. Okay, 30th 300. So this is, a summary or a brief on what? Accounting for bill of exchange from the perspective of the what? Of the buyer. Okay? Or let's say perspective of the debtor and perspective of the what? Of the creditor. Or perspective of the what? Buyer and perspective of the what? Seller. Okay? Now, this is it individually. But when we now have group balance sheet involving bill of exchange, of course now you understand how bill of exchange works. You can have, as usual, a separate bill where the holding company has its own bills receivable and its own bills payable. The subsidiary has its own bills receivable and its own what? Bills payable. That is yet to mature as at the time we are reporting. Okay? So, when you have that kind of scenario, this is what it looks like. This is the holding company's balance sheet. Subsidiary is what? Balance sheet. Of course, bills receivable is an asset. So we say asset. So we have bills receivable. Let's say this guy is 100. This guy is what? 50. So these are separate bills, not connected. So that means when you are now consolidating, bills receivable will be what? 100 plus what? 50. That's one what? 50. The same thing with bills payable. Bills payable is a liability. So we have bills payable. Let's say this is 50, this is 30. Okay? At consolidation, bills payable will be what? 50 plus what? 30, which is what? 80. So this is a scenario where they are separate bills. It's not connected. Holding company is not connecting any bill with the subsidiary. Subsidiary is not connecting any bill with the what? Holding company. Okay, or what you can as well call intra-group bills. So now that's for separate. Now, what we now have intra-group bills or there's connected bills. So you can have intra-group what? Bills, or let's call it connected bills. That is, the holding company bills is connected with that of what? Subsidiary. So that means that here, for instance, bills payable for holding company is 100. Subsidiary is what? 50. Now, of course, in this receivable, if let's assume that 20 naira out of this 100 is from the subsidiary, that means that the holding company has a connected bill with what? The subsidiary. So of course, don't forget that if one is receiving, the other is payable. So that means the holding company, if they have 20 receivable from the subsidiary, sometimes we have 20 payable to the holding company. So that means if 20 is receivable from subsidiary in this 100, that means 20 will be payable to what? Holding company in this 30. So there's a credit here, there's a debit here. Okay? So at consolidation, this 20 will cancel out this what? 20. Okay? That will mean that, okay, your bills receivable will now be what? This will now be what? 80 plus 50. Okay? Which is 130 instead of 150 because there's a connected bill. Okay? So, of course, you understand what I mean now. So, it could be the other way around as well. So, what I'm saying is that in intra-group bills, the holding company can have receivables from the subsidiary. The subsidiaries can have receivables from the holding company. The holding company can have payables to the subsidiary. Subsidiary can have receivables from the what? Holding company. So you have to be able to what? Rectify the cancelling out. Like I've explained here, 20 out of this 100 receivable from the subsidiary. That means in the payables here, 20 out of this 30 here will be payable to what? The holding company. So when you what? Consolidate, you know what? 80 plus 50, which is 130. Payable will be what? This payable will be what? 50 plus 10, which is what? 60, because 20 has counted out 20 here. Okay? Now, that is for intra-group bills or connected bills. But there's something that can happen as well. It is possible that the holding company, or whoever is having the receivable bill, can discount it. So discount means instead of waiting till maturity, you can go to a discount house or another finance house to what? Take the money, pay the money to mature. Of course, when you say discount means you're going to lose some out of it. Okay? So what I'm going to say is that it is possible to have intra-group bills with what? Discounted factor. Let us say discounted intra-group bills. So let's assume that, of course, the holding company has 100 bills receivable. 20 is receivable from what? From the subsidiary. And let's assume that out of these 20, the holding company now discounted 5. 5 has been discounted of this what? 20. That means there's a third party involved in this 20 that is due from the subsidiary. So what do we do in that extent? It means that what is left due from what? The what? Subsidiary is 15 instead of what? 20. Okay? So in that scenario, what you will cancel out at consolidation is the 15. So this 15 will now cancel 15 here instead of 20. So this will be remaining 15. This will now be remaining 85 instead of 80. So that means that at consolidation now, your bill will now be what? It will be 85 plus what? 50, which is what? 135. Payable will now be what? Payable what? 50 plus what? 15, which is what? 65. Because of the discounted what? Amount. Okay, so that's the summary. Okay? So what I actually said here is simple. That bill of exchange can be separate. Bills receivable is an asset, bills payable is a liability. So holding company can have separate bills receivable, separate bills payment, bills payable. So they can have separate bills receivable, separate bills payable. At consolidation, you just add them up and move on. But you can have intra-group bills where holding company is expecting the maturity of some bills from the subsidiary, or subsidiary expecting from the holding company. So in that scenario, you have to know what is due from the holding company or due to the holding company from the subsidiary and cancel out from the receivable and payable. Okay? And then proceed with your consolidation. But when there's a discounted amount, of course, that amount has been discounted from what is expected from the subsidiary, or whichever way it goes, you have to know it. And once you take that out, whatever is left is what you cancel out at what? Consolidation. So take your time, go through. If you have questions, you can read on the numbers displayed to reply with the right answers. So let's take a question that will help us understand what we're talking about. We're taking two questions, of course. One. So let's quickly take a question. We're taking two questions basically, so we understand, that aspect where there's no discounted bill of exchange, and then the aspect where there is discounted bill of exchange. Okay, so we'll find a way to make it easy there. So let's go. We have the first one here. Say the following represent balance sheet of King's PLC and Queen's PLC on 31st December 2018. So we have Kings and Queens there. The assets are there. Land and building, furniture and fitting, debtors, bills receivable, shares in Queens, cash at bank. And we have long-term liabilities here. Venture. We have short-term, there's bill paid here. Then we have preference shares, reserve, ordinary share. We have information here. Quick one. Kings acquired 80% ordinary shares in Queen's PLC on 31st 2016 when reserve was 200 naira. The bill receivable of Kings PLC includes 100,000 naira from Queen's PLC. You're required to prepare the consolidation schedule and the consolidated statement of financial position as at 2018. So this question is helping us test, our understanding of bills of exchange, bill of exchange. Okay, rather. So let's go. We have the consolidation schedule. Of course, there's cost of control here. That's Kings and Queens. How many percent do you have there? And see 80%. So this 80%. Okay. It's 80%. And then we have to be sure, is there any holdings on the preference share there? There's no holding on the preference share. No holding on the preference share. So that means we have minority interest. That will be 20%. Right? And then we're going to have the CP and L. Okay. So we have Queen. So what's the ordinary share here? According to the question, what's the ordinary share according to the question? What's the ordinary share of Queens? Ordinary share here, you can see 1,500. So this is 1,500. So 80% here. Then we have 20%. 0.8 times 1,500. What do we have there? 1,200. So this will be 300. What's the next one? The reserve. What's the reserve there? Reserve there is 800. So we have our reserve here. 800. So what do we do? We have 800 into pre and what? Post. So what's the pre? Question said Kings acquired 80% of 9 shares in Queens on 31st times when Israel was what? 200,000. That's 200. So what do we do? The pre here is 200. This will be what? 600. So this times 0.8 times 0.8. This will be times 0.2. So 200 times 0.8, what do we have? That's 160. So you have 160 here. Then what do you have here? 600 times 0.8. 480. Then 800 times 0.2. That's 160. So when you add this, what do we have? 160 plus 160 plus 480. That's 800. Right, so our preference share, according to the question, is what? Preference share is 700. But you agree with me that Kings does not have any share in it, so it's all for minority interest, right? So that's it. Any other thing there? So let's proceed. We have this. This is 0631. This is 06. I think this is 11. Right? Okay. And check it with your calculator. 300 plus 160 plus 700. 1160. Okay? 200 plus 160. 1360. So this is your net asset acquired. So let's go. Cost of investment. What's the cost of investment? I see here shares in coins, 2,500. We have 2,500. So what do we have? So 500 minus 1360. 1140. 1140. So this is your what? Goodwill. Debit balance goodwill. So this guy here, 1160, is your minority interest. So what is King's Reserve? King's Reserve, based on the balance sheet, is 1,400. We have 1,400. So what do you have? That's 1,880. Check. 1,400 plus 480. 1,880. So this is CP and what? L. So with this now we can prepare the consolidated statement of financial position. Okay? So let's go. We'll say what? Kings and its what? Subsidiaries. So say what? Consolidated statement of financial position as at 31st December 2018. Okay, so let's go. So I'm going to, make it appear. You see the one without discount, one that has or discounted. So let's say we have these are assets because we don't have notes here, right? So this is question 1. This is without what? Discount. So let's go. What do we have? Assets. We have non-current. What are the non-current assets there? You see non-current. So let's call that note 1. Let's put that somewhere here. So what are the notes? You have land and building, furniture and fittings. Land and building. So what land and building there? 200 plus 600. You have 1,800. Furniture and fittings. What do you have there? 900, 700. This is 1,600. So what do we have? 1,800 plus 1,600. Three 400. You have 3,400. So we have 3,400. So let's go current. We have use 2. What are the current asset items there? We have debtors. Debtors. What debtors there? 800, 1,200. I think this is 2,000. What do we have there? Bills receivable. Any note on bills receivable? Yes. Look at what they said here. Said the bills receivable of King's PLC includes 100,000 from Queens. I already explained that if the holding company is receiving bill from the subsidiary, then subsidiary is what? Paying to the what? Holding company. So there's receivable, there has to be payable. So the question says 100 out of the bill receivable of what? Of the holding company is from the subsidiary. So that has to cancel out. Okay? So it means that the receivable of the holding company will be 900 minus what? 100. That's 800, right? So we say 900 minus 100 plus what is the subsidiary? Bill receivable there is 600. 5 plus 600. So that will be 800 plus 600. I think that's 1,400. Okay. What else? We have cash at bank. What's the cash at bank there? 1,51200. So that's what? 2,700. Any other item? No. So we have 2,000. 2,000 plus 1,400 plus 2,700. We have 6,100. So that's 6,100. So what else? Goodwill. What's the goodwill here? 1140. So let's add up. 3,400 plus 6,100 plus 1140. That's 10,640. Okay, so we have liabilities now. So long-term liabilities, note 3. What's the long-term liability? We have debentures. Debenture there is subsidiary is 1,000, holding company 1,500. 1,500 plus 1,000, so that's 2,500. So what do we have now? Short-term liabilities. Note 4. So what do you have there? Bills payable. So holding company's bills payable is what? 820. But remember, the holding company is expecting from the subsidiary. And so subsidiary is payable to the holding company. So holding company's subsidiary is payable here is 300. Remember, holding company has 100 receivable from the subsidiary. So that will net up. Taking out here, you have to take out here. So that will be 820 plus 200. So what do you have? So that's 1,020. Let's check. $1,020. We have 1,020. So what's the next thing you have there? Reserve. What's our reserve here? 1,880. What do you have? Preference share. What's the preference share of the holding company? 1,000. So what's the ordinary share? Ordinary share is what? 3,080. So what do we have? 2,500 plus 1,020 plus 1,880 plus 1,000 plus 3,080. Then we have minority interests. What minority interest? 1,160. So you add up 1,160. What do you have? $10,640. This is your total liabilities. This is your total assets. Okay, so So this is the first question where the bill has not been discounted. So we'll take the next one where the bill has been discounted. Okay, so let's go. So we have it here. The full represent the balance sheet of Kings PLC and Queens PLC that the 2018. So we have everything here. Land, building is the same thing with the previous question. Here everything is the same thing except for the fact that the bills receivable of Kings PLC includes 100,000 from Queens PLC, of which 50,000 has been discounted by Kings PLC. So apparently everything is the same thing, but they're telling us that the bills that is receivable, 100,000 is due from the subsidiary, but then they have discounted it before it matures. And I already told you what to do. In that aspect, since there's a discounted part of the bills receivable that is expected from the subsidiary, then that means a third party involved. So the one that has not been discounted is what we net off. So that means, excuse me, that this is discounted. It means this will be the same thing, but this guy here will change because you see this place bills receivable. Let's call this note 2A. Let's call this note 2 discounted. So that means debtors will be the same thing. 800 plus 1,200. That's 2,000. Bills receivable will now be 900 minus 50 plus 600. So that will be 850 plus that will be 1,450. Bank will remain the same. 1,500 plus 1,200. That's 2,700. So what do you have? You add up. You have 2,000 plus 1,450 plus 2,700. 6,150. 6,150. So it's 6,150. Goodwill will remain the same. 1,140. So when you add, you have 3,400 plus 6,150 plus 1,140. That's 10,690. So for this, it's the same thing. Remain 2,500. This short-term liability now. Note 4, what do you have there? This is note 4A. Let's do note 4 discounted. So what's note 4 discounted? So that's bills payable. So that will be 820 plus 300 minus 50. So what do you have? 820 plus 250. That's 1,070. So here will be 1,070. 2070. Your reserve will remain the same. Preference share will remain the same. Ordinary share remains the same. Minority interest remains what? The same based on the question. So let's add. So we have 2500 plus 1070 plus 1880 plus 1000 plus 3080 plus 1160 10690. Okay, so excuse me, let me check. 10690. Yeah, assets times 2. We have total liabilities here to be 10690, total assets to 10690. So this is for the discounted part of it. This is where there's no discounted bill of exchange. So what we've done here is to take a question, or take two questions rather, that helped us with group balance sheet involving bill of exchange. So we're able to test an aspect where the bill has not been discounted, and then we'll tell another aspect where the bill has been discounted. So take your time, go through it. If you have questions, you can reach me on the numbers displayed. I'll be able to prepare with the right answers. Don't forget you can support us by printing the account numbers displayed or sponsor copies of my textbook for free distribution to students. Thank you. See you next class. Bye.